What's up, traders? So today I'm going to show you my 5 favorite monthly paying dividend ETFs that all pay within a range of 4% all the way up to 14%. And I'll show you exactly how I use the will strategy on them in order to boost the dividend even more significantly. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple 6 figures a year from the stock market, and I use the money I make from the stock market in order to pay for my entire lifestyle. Now, before we begin, I need you to smash the like button. So if you want to take any of your 5 digits, and if you're on the phone, just lightly press that thumbs up button, or if you're using a computer, just go ahead and click it. But that just helps the video get pushed out to more people. And just go ahead and subscribe while you're at it. And do remember that I'm not a financial advisor, and this is not financial advice. All trading comes with risk. I'm just showing you how I've built wealth over time. Now, every single ETF that I'm going to mention is a covered call ETF. And if you're new to options, a covered call is just when you agree to sell shares of a stock that you already own at a fixed price. And for doing so, you get paid money up front, which is called a premium. All right, so say I own ABC stock and it's currently trading for $20 and I sell a covered call at $25. Well, what I've done is I've agreed to sell my shares at $25 if ABC stock were to rise above the $25 mark that we set. And for doing so, I get paid money up front. So let's say for this example, I got paid $100 up front. Well, what happens from here is if ABC stock stays below $25, I just keep that $100 I received and I go about my day, and I can do this trade over and over and over again. However, if ABC stock were to go above the $25 mark that I set, then I have agreed to sell the shares at the $25 mark. However, I still get to keep the premium that I was paid to begin with. Now, of course, you can do that on your own with stocks that you own. However, there are ETFs that do that internally. And because they receive such a huge premium from selling the covered calls, they give you, the stockholder, a pretty large dividend because they are receiving so much money from the covered calls. And so let's dive deeper into how that works. Now, with the covered call ETF, the ETF owns a bunch of stocks. It could be Apple, Microsoft, and any other big name company. Okay, so that is the first thing. And then secondly, it sells call options on those stocks. So they sell covered calls, which is like offering to sell them at a set price in the future. And then thirdly, the ETF collects cash, which is the premium from selling those options. And then fourthly, that cash is sent to you, the investor, as income, usually every single month. And when it comes to dividend paying stocks, I much rather prefer the monthly paying ones rather than the quarterly ones. But now that we have that information, let's go ahead and take a look at the 5 ETFs. And the first one is DIVO, ticker symbol DIVO. Now, out of the 5 ETFs, this one pays the lowest dividend yield. And we can see it right here. It is 4.73%. However, out of the 5, this one will typically get you the most capital appreciation because this fund only sells covered calls on certain stocks at certain times. All right, so the downfall with covered call ETFs is you typically don't have much capital appreciation because due to the covered calls, you are agreeing to sell stocks if they rise to a certain point. And so typically you're very limited on capital appreciation because you're always selling stocks when they rise up. Well, the difference with DIVO is they only sell covered calls on specific stocks at specific times. And so due to that, it allows for a little bit more capital appreciation. All right, so if you are looking for a monthly dividend ETF that pays a decent dividend and you also get capital appreciation, then DIVO is a good option for that. All right, and we can see that the management fee is about 0.55%. However, that's not very significant when you consider the dividend yield. Now, how DIVO also differentiates from the other ETFs that we're going to discuss is that it doesn't hold very many companies within the ETF. So if we take a look here, we can see that it currently holds about 34 companies within this ETF, and the top 10 holdings of the ETF make up almost 50% of the entire ETF. But we can see we have names like Meta, Visa, IBM, Microsoft, Caterpillar, Home Depot, Chase, American Express, Goldman Sachs, etc., etc. And so if you do like many of the companies that you see here, then this could be a great option for you. However, now let's take a look at the other ETFs. Now, the next 2 ETFs are very comparable based on the stocks that they hold because they both follow the S&P 500. And so the 2 stocks are SPYI and JEPI. And SPYI is an ETF that is ran by the NEO Group, and JEPI is an ETF that is ran by JP Morgan and Chase. And so JEPI is a little bit more established and is a very popular option, and it currently pays an 8.34% dividend, while SPYI is a newer ETF offering double-digit income from S&P 500 covered calls. And they both employ similar strategies, but with different execution approaches. Now, because they are similar, let's go ahead and take a look and compare both of their performances over the last year. So looking at the two, we can see SPYI's price is about $49 and JEPI's price is about $55. And we can see looking at the 20-day average volume that JEPI is quite a bit more popular, with their average volume being about 4.9 million and SPYI being about 1.5 million. But like I said, that is to be expected because SPYI is a newer ETF than JEPI. And with that, we can see down here, now this says market capitalization, but when it's an ETF, this is simply showing the amount of assets under management. And this number is showing in the thousands. And so SPYI has about $3.3 billion worth of assets under management, while JEPI has about $39 billion. Now, when it comes to looking at their performance over the last 12 months, we can see that SPYI had capital appreciation of minus 1.78%, while JEPI had capital appreciation of minus 1.12%. So they perform pretty comparatively. However, because SPYI has a dividend yield that is almost 4% higher, that means that SPYI has outperformed JEPI over the last 12 months. And so that is good to know. However, let's take a look at the last two ETFs. And then once we do that, we can compare all 5 ETFs to see which one has performed the best. All right, so the last two ETFs are QQQI and JEPQ. Now, these ETFs are owned and ran by the same two companies that own SPYI and JEPI. All right, so we have another NEO-owned ETF in QQQI, and we have another JP Morgan-owned ETF with JEPQ. Now, the only difference with these are that they follow the NASDAQ 100. All right, so they both follow 100 large cap companies within the US that all have a tech focus. Now, QQQI pays 14.31% as of currently, and then JEPQ pays 12.3%. And again, they both employ similar strategies, but with different execution approaches. So now let's take a look at QQQI's performance versus the more popular JEPQ. All right, so now we're looking at a chart comparing QQQI to JEPQ, and we can see that QQQI's price is currently $51, while JEPQ is $52. And the average volume for QQQI is 1.6 million, while JEPQ is 6.3 million. And as far as assets under management, QQQI has 1.4 billion, whereas JEPQ has $24 billion. Now, as far as performance over the last 12 months, we can see that QQQI went down about 2.18%, whereas JEPQ, the more popular ETF, has gone down by 4.48%. So QQQI already beat JEPQ by over 2% when it comes to capital appreciation. However, now if we factor in the dividend yield, it gets even worse. QQQI outperformed JEPQ by nearly 5% when everything is factored in. And that is pretty significant when we're talking about two ETFs that follow the exact same sector. But now that we have that information, let's go ahead and compare all 5 of them and see which ones performed the best over the last 12 months. All right, so now we have a chart comparing DIVO to JEPI to JEPQ to SPYI to QQQI. Now, if we look down here at the 12-month performance, then we can obviously and quickly see that DIVO has outperformed all of them. Now, if we recall from the beginning of the video, we know that DIVO uses covered calls a little bit more selectively, which is why it had such a lower dividend yield than all the rest of them. And so naturally, when we are having a bull market, which we have had over the last 12 months, DIVO is probably going to outperform every time when it comes to capital appreciation. And then the opposite is true as well. During a bear market, it's going to underperform all the rest of the ETFs, as the other covered call ETFs will go down at a slower rate. But since we've had a bull market, we can see that DIVO has gone up 7.10% over the last year, whereas the other 4 have gone down anywhere from 1% to 4%. But that is just the capital appreciation. Now, if we factor in the dividend yield, then who is the biggest winner out of the 5? All right, so looking at total performance, when we factor in both the capital appreciation over the last 12 months and the dividend yield, DIVO did 11.83% over the last year, which is a very nice number. But now let's take a look at JEPI. Well, JEPI did 7.22%. So not as great as DIVO, but let's take a look at the others. JEPQ did 7.07%. Now, JEPI and JEPQ are the 2 most popular ETFs out of this listing. And so it's interesting to see that they are already lagging behind the competition. But now let's take a look at SPYI and QQQI. All right, so SPYI did 10.6% over the last 12 months. And then last but not least, let's take a look at QQQI's performance. All right, and we clearly have a winner over the last 12 months. QQQI has outperformed every single ETF that we are looking at currently, so it is the reigning king over the last 12 months. Now, past performance never guarantees anything beyond just that. We could look at this listing a year from now and see that the king has changed. However, the only decisions we can make currently is based off the information that we currently have. And as of right now, QQQI performs better than them all, and also outbeat its comparative ETF, JEPQ, by over 5%. And so the fund managers clearly have a good strategy in place. And because of this, QQQI has been my favorite monthly paying dividend ETF to trade. And now I'm going to show you how I use the will strategy on this ETF in order to bring in an even higher return than what you see here. But before we do that, if you know anybody who can use help generating income off the cash that they already have, then tell them about the Trade to Freedom community. Not only will they get to see my exact trades as soon as I answer them, but they'll also get my full options framework via the Trade to Freedom course. Thirdly, they'll have access to ask me questions at any given time. And lastly, they'll be within a community of other traders who all have the exact same goals as them. So if you do know anybody, the link is below in the description. But we have strategies day trading all the way up to monthly income strategies for people who are much more busy. So if you do know anybody, share the link. The link is below in the description, but let's get down to business. All right, so now I've put up the Thinkorswim platform, and now we are looking at the options chain for QQQI. Now, when we do the will strategy, what we're doing is we are selling a put in order to buy shares of a stock at a cheaper price, and we get paid for doing so. And then whenever we are forced to buy those shares, we will then sell covered calls in order to sell that stock at a higher price, and then again, we get paid for doing so. And so let's take a look at how that works out. So when I start selling puts, normally I'll go up to 45 days out. So if we look at the expiration dates over here, 29 days would fit that criteria. So I'll go ahead and click that. And I do want to point out, if we look right here at this little red marker, that just shows you that I have an open trade at that strike price. And so you can see that I do put my money where my mouth is, because I have several contracts open up at that strike price. And this trade signal was given to the community several weeks ago, so we are already up on that position. However, if I was placing a trade here today, then I would likely place it right here at the $51 strike. Okay, when you are selling puts on high dividend ETFs, you typically have to go pretty close to the money in order to get a decent amount. And so we can see at this $51 strike, we will get paid anywhere between $65 to $120 upfront right here, right now. And all we are doing is we are agreeing to buy the shares at $51 if by expiration date, the stock price is below that marker. So with the stock price currently being $51.20, if it were to drop below our $51 strike, then we are agreeing to buy 100 shares of this stock per contract that we have. Okay, and so you do want to make sure that you do have the funds available to purchase the shares, because that would be about $5,100 that you would be forced to buy at $51 per share. And so if that trade sounded good to you, you could just come over here. I'll select the bid price, and then your broker should automatically load your ticket for you. So you can see we are selling. And then over here, you can do however many contracts you like, but you should do whatever is best for your account size. But let's say for the purposes of this video, I'll do 5 contracts. And we can see at the mid price, we'll receive about $92 upfront right here, right now, per contract for placing this trade. And then if you like that trade, you go ahead and hit review and submit the order. However, let's go down to the P&L chart and see how this works out. All right, so we can see, looking at that top left number, that we received $465 right here, right now, for placing this trade. And typically how I do it is I will kind of dollar cost average into the trade. So I'm doing 5 contracts right now, but then maybe tomorrow I'll do another 5, and then the next day I'll do another 5. And I'll continue to do that until I reach my full position size. But that top left number will show you how much the contracts will be worth upon expiration day. And so if we look at these red dots right here, that is where QQQI's stock price is currently. And so as long as it stays right there, we just keep that $465 that we received and we go about our day. If the stock price were to go up, we keep the $465 we received and we go about our day. If the stock price even goes down some, we just keep the $465 we received and we go about our day. But you can see, once we get below the $51 strike that we set, then we start to make less and less money off of this trade. And then eventually we get to the break even point, and it looks like our break even will be right around $50.08. And then if the stock price were to go down even further than that, then the contracts become less and less and less. However, we don't care about that part because we were fine with buying the shares at the strike price that we selected. And that is the great thing about selling puts, is either you get paid just to wait around for a stock price to drop and it doesn't happen, or you get paid to wait around for a stock price to drop and it does happen, and you get to buy shares of a company or an ETF that you really want at the price that you would really like to purchase it at. And so when you only sell puts on companies that you would actually like to own, it's kind of like just a win-win situation. You really can't lose when you go about it and you think about it in that way. All right, but now let's assume that the stock price did drop and we were assigned the shares. So we had to purchase 100 shares of the stock per contract that we have. Well, great. Now we have a monthly paying ETF that pays an over 14% dividend yield. And so we could just hold on to the stock and continue to get our monthly check every single month. And that is totally fine. Or we could turn around and sell covered calls. And so let's go back up to the options chain and look at the covered call side. Now, when it comes to the covered call side, I will go up to 90 days. And the reason for that is because now we own the shares. Now we're getting paid monthly anyway. So there's really no rush to lock in the covered call premium because we are going to get paid monthly from the Dividend ETF itself. And so now let's come over here to the options chain and we'll select this expiration date that is 57 days out from now. And from here, again, you want to come somewhere near the money. So I would be looking at either this $52 or $53 strike. But let's say you want a better chance that you keep ownership of the shares. So you want to come over to the $53 strike. Now we'll go ahead and select that per normal. And we can see at the mid price, we will receive about $60 per contract. Well, now you're probably saying, well, Rashad, that's not a huge return for an expiration that is 57 days out. Well, actually, that's over a 1% return in the span of 2 months. And so if we annualize that, that would be over a 6% return annualized. And so when we pair that with the already 14% dividend yield from QQQI, now you're looking at about a 20% dividend. And as long as QQQI stays below that $53 cover call strike that we set, you can just keep the shares and continue to do the strategy over and over and over again. However, QQQI does go above your strike price. Well, yes, you will be forced to sell your shares at that price, but hopefully by that time, you'll have received a few payments of your monthly dividend from owning the shares of QQQI. And that is the power of using the will strategy on a monthly paying dividend ETF that I utilize all the time. But ladies and gentlemen, that is it for this video. I hope you learned a ton. I hope God blesses you in ways that you could not even imagine. And again, if you know anybody who would like to join the Trader Freedom community, the link is below in the description. But make sure that you like the video, subscribe to the channel, and I will see you guys on the next one. Peace!